Target date funds, TDFs, are some of the most popular options in the average 401k plan. According to Vanguard, an astounding 83% of all 401k participants invest in target date funds. There are a few reasons for this astounding number. Firstly, the idea of set it and forget it that TDFs seemingly offer attracts many people. Secondly, the default retirement option for many employees is a TDF. In fact, employers can even auto-enroll you into one. TDF? More like WTF. With so many people invested in these, it's worth asking, are these actually good investments or are you getting screwed sideways? Target date funds are usually mutual funds that contain a mix of stocks, bonds, and other investments. They're usually named like Target Retirement 2040 Fund. The 2040 means that it's for people who want to retire around 2040. TDFs are meant to be long-term investments for people with a particular retirement date in mind. In short, these funds will handle your asset allocation or how you split up your money to decrease your risk for you, but that can be a blessing and a curse. The fund manager usually decides on a glide path, which is basically a schedule of when the fund will become less risky as you get closer to your retirement. However, there is no single glide path and each manager can pick their own. At first, the fund will usually focus on taking more risks to grow your money, such as through stocks. As it gets closer to the target date, it will focus more on safer choices, such as bonds. If you're enjoying this video so far and finding it helpful, please make sure to like the video. Did you notice that I mentioned risk before growth? Risk is guaranteed, but growth is not. People often think that a TDF is flawless and a foolproof way to protect against market volatility, but that's just not true. Imagine it's early 2008 and you're close to retiring. Your 401k balance is looking good and your 2010 TDFs are performing wonderfully. Since you're only 2 years away from retiring, you trust that your funds are invested very safely. Millions of Americans thought this way until the 2008 financial crisis crushed their retirement hopes. In fact, numerous 2010 TDFs had anywhere from 40 to 70% in stocks and dropped anywhere from minus 17% to minus 42%. The 2020 TDFs have also suffered a similar fate in 2022, as funds from Fidelity, JP Morgan, and Vanguard took double-digit dives. The asset allocation for these funds differed but had around a 50-50 split. TDFs are built on two giant assumptions. 1. Bonds are safe, which is not true. The price of bonds and bond mutual funds will drop when interest rates go up. 2. Bonds travel in the opposite direction of stocks, so that if stocks fall, bonds will protect you. Also false. Stocks and bonds do not always move in opposite directions, as people saw when both stocks and bonds took a free fall in the 2008 financial meltdown, and again in 2002 when the S&P 500 and the Bloomberg US Aggregate Bond Index both dropped by double digits. Furthermore, there are numerous misconceptions about how TDFs work. People think that TDFs don't lose money, have a guaranteed rate of return, and provide a guaranteed income stream in retirement, none of which are true. A TDF is not a plan to get you to your goals, but it is simply an asset allocation that should become less risky as you approach retirement. However, TDFs do offer a few benefits. By owning a TDF, you autopilot your investment decisions and the fund manager will diversify for you. Of course, the fund managers do not work for free. TDFs are on the more expensive side when it comes to mutual funds, and you also can't change the fund's allocation based on your changing needs. Nevertheless, target date funds can be the lesser of two evils. Before TDFs, a lot of employees invested in their company's stock. Could you imagine relying on Enron, Lehman Brothers, or Blockbuster stock for your retirement? Buying a TDF is like eating at McDonald's. Instead of starving to death, you get to eat at McDonald's. It's not the best for you, but at least you won't starve to death. If the concept of a TDF is appealing to you, go get a low-cost one from Vanguard. However, another option you have is hiring a financial advisor. If you do choose to hire a financial advisor, you must make sure he or she is a fiduciary. There's a massive difference between the two. This next video will cover what the differences are between a financial advisor and a fiduciary.